Welcome back to the program. Today is FOMC day. The Fed cutting rates by 25 basis points. This was what was expected. But we're going to look to the press conference of Jerome Powell now in a few minutes. And it's a little bit of a hawkish cut here by the Fed, setting their guidance for only 2 rate cuts for 2025. So perhaps inflation being a little more sticky than what the Fed has expected. Let's have a quick look here at the markets. And as you can see, Bitcoin dumping here a little bit after the announcement and of the rate cut here. Bitcoin down about 1%. Let's have a look here at the other markets. The S&P here down about 0.5%. And we can see that the market did not really take kindly this really guidance from the Fed here. The market expecting more rate cuts, of course, to fuel the rally. But of course, you have to keep in mind that we are at the top of the market, all-time high here. Just a few days ago, over 6,000. We're still over 6,000 here at 6,020. We went as high here as 6,060. How much is it? 6,000, almost 6,100. So really, we're still at the top of the market, but of course, the market always wanting more juice. Let's have a quick look here at the dollar, the reaction here, the dollar going up here on this hawkish Fed decision. And let's have a look here at the yields, the 10-year, same thing, 2-year also. And let's have a look here at the 30-year. Everything all across the curve here. All the yields moving up. Dollar moving up. Gold moving down. Most risk assets going down. But we're going to have to see now the conference by Jerome Powell, because this is going to be the most important. Of course, we were expecting 25 basis points of a cut. That's what we got. But perhaps now the market is surprised a little bit by the guidance and projection of the Fed for 2025. Only 2 rate cuts. Of course, that is subject to change. This is just predictions and provisions, and the Fed is going to react as the data comes out. So, of course, now they're saying 2 rate cuts, but we might have a lot more, or we might have a lot less. But now we're going to see in just a minute now Jerome Powell in his press conference.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the 3rd quarter, about the same pace as in the 2nd quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
So he didn't really answer the question. He was like, yeah, I'm not going to tell you what's going to happen in January. And of course, he doesn't want to say he's not going to cut. He just wants to leave the door open and say, we'll stay data dependent.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but it would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points, so it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to.
All right, folks, we want to break in here because Jay Powell is certainly being pressed on exactly why the cut, why the need for a cut today. Also, just how much are they assuming these new policies will be inflationary? Daniel DiMartino Booth, Ali McCartney, and Francis Donald with us. Francis, you're saying that you think they're trying to have their cake and eat it too.
Yeah, or maybe a more generous observation would be that they're trying to inject optimality. Chair Powell starts with, the economy is strong, but also we need to cut interest rates. He says, inflation is coming down, but not as much as we want. And then he says, we can dial back more slowly, or we can accelerate cuts. So clearly, reads to me as not having a lot of confidence in their outlook, and maybe that's appropriate. We've had significant data distortions from weather to revisions. Danielle, right. You've been all over that. We, of course, know that there's policy that can be very disruptive. They say they're not incorporating policy, but I tell you, they're going to bed thinking about it at night. And then lastly, a lot of those economic models been breaking down. To me, it reads as a hold. Can we just hold the line for another 30 days, try to get a sense of what's going on type of statement?
When you're data dependent and the data is revised at the pace it's been revised, it's hard to really have any sign of secure footing. By the way, you picked up on that dark room full of furniture line that they used once before, back when inflation was a consideration, right?
That's right. Chair Powell bringing out some oldies but goodies when it comes to metaphors. One from 2018, when the room is dark and it has lots of furniture, you turn off the light, you have to go more slowly. A lot of language today about going more slowly, more cautiously. This is a Fed that's trying to buy time.
Before you even started speaking, Ali, you picked up on that. You said you think the Fed is afraid of what may happen with respect to fiscal policy.
Look, and they should be in terms of extent and timing, right? As you said, their data is breaking down. He used the term inflation has fallen apart from what we thought at the beginning of the year to the end. That may be the most sort of aggressive, culpable language we've ever heard him use. And then we're talking about, the extent. He just took back from 4 to 2 to match the market. And the timing, in the reverse. And then, it's 150 basis points between what neutral is from the top dot to the bottom dot. I just heard Danielle say that that's the largest range we've seen in a long time. Yep. So you can drive a truck through the range. It's getting wider and wider. Timing, we knew they weren't going to go in January because of the presidential transition. Right. That's gone from about 11% odds probably to 8.6 now. March now looking, 40-ish. It could be second quarter, it could be third quarter, it could be not at all.
Danielle?
All I know is that their end of the year unemployment rate projection for this year implies that we're going to go from 4.246 to 4.200. They've taken that down despite the fact that in the month of November, all you had to revise the unemployment rate up by was 7,100 employees total. And you would have gotten that 4.3 top tick print for the post-pandemic era. And yet they're suggesting that this economy effectively, because of where their median projection for the unemployment rate is actually heating up in terms of jobs being created.
But he also acknowledged the chart you and I had with the folks not being able to...
You're not seeing it with people. If you lose your job, good luck finding another one.
Right.
Because, again, we're at 10.5 weeks, median duration of employment, highest since October 2008. It ain't easy out there if you lose your job,
How surprising
folks.
is it right now the
All right, so here it is. We have seen Jerome Powell here telling us what he's seeing. And the bottom line here is they have no idea what they're doing. The metaphor, as he was saying, going into the room full of furniture with the lights off or driving in the fog. You got to slow down when you're not sure where the data is pointing to. And I think the whole press conference was a little bit about that. They just don't know. They're waiting to see what is the data going to say in terms of inflation and the labor market. And there's this double risk, double-edged sword. And of course, they don't want to fall in any of those traps. But, in the end, perhaps they will have no choice. And it will play out in one way or the other. And the Fed will end up on the wrong side of history, no matter what. If it is the labor market that just breaks down, then the Fed will have been too slow to cut rates. And if it is inflation that picks up again, then the Fed will have been too fast to cut rates. Maybe there is no way to win here for Jerome Powell. And no matter what, you could end up with the worst scenario of all, with the inflation still ticking up and the labor market breaking down and having the stagflation that a lot of people have been saying is going to happen. We will have to see what happens. But so far today, really nothing new here. Nothing burger of a press conference here. They have no idea where this is going. And when you think about it, when you look at the inflation cycle in the 80s, then maybe it is sort of the same thing that we're seeing. Inflation doesn't rebound like this in cycle because the Federal Reserve decides to crank up inflation once again. No, it happens because they think that they've won the battle against inflation. And as it turns out, they had not. And then you get this reflation, and then you go on for another cycle and you have to hike rates again, and you damage the economy and the labor market over and over until someone comes like Paul Volcker and decides this is it. It stops with me, and hike rates to a point where you provoke a recession and you finally destroy and vanquish inflation. We will have to see if that's going to happen to Jerome Powell. Perhaps Jerome Powell will not even be there when that happens to be the case. Perhaps he's only going to stay until everything breaks down, and then he will wash his hands clean and say, well, it wasn't my fault. It wasn't under my leadership that everything fell apart. But if that ends up being the case, then he will really have been the architect of the downfall. Anyway, we will have to keep a look at the market and see what happens. Of course, we will follow what happens in January at the next meeting. Be sure to subscribe to the channel if you want to keep up with all this information. Leave a like on the video, and I will see you all on the next one. Thank you for watching.
Hit me with that like, and sub to the channel. Hit me with that like, and click the effing bell. Click that bit, alright. The algo recommends, for she gon' like. The algo knows you well. Hit me with that like, subscribe to the channel. Hit me with that like, and click the